What would you think if I told you that the economy is based on trust, which has allowed it to develop rapidly, but leaving it with excessively fragile foundations, which once they start to show cracks are very difficult to stop? Today, I will tell you how one of the most central, powerful, yet fragile institutions of the economy works: banks. Although the history of banks dates back hundreds of years before Christ, the modern version of banking appeared in the Middle Ages with goldsmiths. Goldsmiths were responsible for working with precious metals and began offering custody services in their vaults to their clients. Goldsmiths began issuing receipts that represented the gold stored in their vaults by their clients, which was accepted in commercial transactions as paper currency. As it became the preferred medium of exchange for people, it reduced the movement of gold that goldsmiths, now turned banks, had in their vaults, creating fertile ground for one of the pillars of modern economies: fractional reserve banking. Fractional reserve banking emerged when goldsmiths realized that they could use a portion of the gold they had in their vaults and still be able to meet the requests of their clients, because not everyone made withdrawals at the same time. They could also make money from the interest on the loans they made, in addition to the custody service. This led to an explosion of credit that stimulated economic growth by serving as an amplifier of the society's capital. It played a decisive role in economic development, with notable cases like Switzerland, where through the first version of Credit Suisse Bank, money was lent for the development of the railway system, with workers accepting to have their money deposited in the same bank, thereby unleashing the amplifier effect of fractional reserve banking. However, not everything is positive. The amplifier effect of fractional reserves is a double-edged sword. The fewer reserves banks have, the greater the effect, the availability of credit, and the potential profitability of the banking system, but also the greater their vulnerability and the possibility of bankruptcy. Since banks use the deposits they receive from individuals and companies to make loans, they do not have the capacity to meet their clients' demands if many of them withdraw their money at the same time, in the phenomenon known as a bank run. Bank runs occur when banks are unable to meet the demands of their clients for the deposits they hold. While under normal circumstances a bank is capable of fulfilling its clients' withdrawal requests, there are events that can trigger an unusual withdrawal of funds for which the bank is unprepared. The first event occurs due to the deterioration of the bank's portfolio caused by bad loans. If a bank grants a large number of loans, its reserves will diminish, and if those loans are not repaid, the bank will face losses that, when made public, may generate mistrust, leading people to withdraw their money and transfer it to banks they consider safer. The second event is triggered by an increase in competition regarding interest rates offered by other banks for deposits, alternative instruments such as government bonds, and recently by the competition from so-called neobanks, with Apple, which is paying an interest rate of 4.15% on its savings account, being one of the notable cases, putting pressure on other U.S. banks to compete in order to prevent a deposit exodus towards companies like these. The third event is usually more systemic and occurs due to a deterioration in the bank's investments. This was one of the main causes of the Great Depression in 1929 and the Great Recession of 2008. When the stock market crashed in 1929, many banks lost most of their funds and had very little leeway to meet their clients' demands. In the midst of the panic of the time, people rushed to withdraw their money out of fear that the bank would collapse, resulting in the disappearance of over 9,000 banks in the United States. During the Great Recession of 2008, many banks invested in mortgage-backed derivatives. When the housing bubble burst, they faced significant losses that rapidly depleted their capital due to their high leverage, leaving them without liquidity to fulfill the withdrawal requests of individuals and companies. This led to the bankruptcy of over 400 financial institutions in the United States. In both crises, the situation faced by banks led to a contraction of credit that affected the real sector and amplified the crisis. If there is a reduction in deposits due to people's lack of trust in banks, there will be less money available for lending, and banks will be more reluctant to lend due to the riskier economic environment. To prevent banking crises, many countries have implemented a series of measures and regulations. However, the results have not always met expectations. In an attempt to harness the benefits of the fractional reserve amplifier while mitigating risks, rules and agencies have been established, and central banks have been granted power and tools to prevent bank runs as much as possible. Each country is different, but broadly speaking, measures have focused on the following points. Firstly, deposit insurance. By insuring bank deposits up to a certain amount, it prevents individuals from withdrawing their money out of fear of losing it in case the bank faces liquidity problems. While this measure helps prevent mass withdrawals by individuals, it often does not cover businesses to a sufficiently high level. It addresses part of the problem, but not the entirety. Typically, the funds used to cover these losses come from a fund created from premiums paid by insured banks. Secondly, risk control. Some countries may establish controls on the level of risk banks can take with their investments and limit or prohibit the use of deposits for investments in stocks, financial derivatives, corporate bonds, and other activities associated with investment banking. This partially disconnects the banking sector from market setbacks so that a sharp decline in a group of stocks due to market panic, which is common in the market, does not lead to a contraction of credit. After all, the Great Depression began with a stock market crash. Thirdly, control of bank reserves and capital. Central banks can determine the level of reserves that a bank must hold in relation to its deposits to ensure the ability to meet withdrawal demands. This is one of the key monetary tools that central banks have to control the amount of money in the economy. However, some central banks have chosen to set reserve requirements at 0% and control systemic risk through the bank's own capital in relation to their assets, along with measures such as interest payments on reserves. Fourthly, emergency tools. On one hand, the central bank can act as the lender of last resort and provide short-term loans to banks that are unable to obtain resources in the market. On the other hand, history has taught us the importance of promptly addressing crises and avoiding a vicious circle that could drag down the banking system. Therefore, banks and central governments often intervene in the market quickly. However, all these measures are not enough to compensate for the damage that can be caused by the loss of confidence, which a system based on trust may face, as has been witnessed in 2023. 2023 has been a challenging year for banks, with the bankruptcy or acquisition by their competitors of Silvergate Bank, Signature Bank, Silicon Valley Bank, and First Republic in the United States, and Credit Suisse in Europe that raises the question of how many more banks can follow suit. The history of other crises is not particularly encouraging when considering the large number of institutions that typically fail in episodes like these. It is completely impossible to determine whether First Republic will be the last or one of the first to face such a fate. Although each bank has faced a different situation, the problem for all of them originates from the increase in interest rates by central banks, especially the Federal Reserve. This increase, completely justified to combat inflation, has caused the assets of these banks to deteriorate and put hundreds of other banks at risk. After years of near-zero interest rates, their rise has led to a decrease in the value of assets owned by banks, mainly treasury bonds and mortgage loans, many of which were acquired during the period of near-zero rates and have now lost value. For example, $1 million in bonds that pay 1% annually for 10 years is now worth only $756,000 in the market if similar bonds now yield 4% annually. The same applies to banks' portfolios of mortgage loans. In the United States, banks have accumulated nearly $600 billion in unrealized losses, meaning losses due to asset depreciation that remain on their balance sheets. This wouldn't be a problem, or at least not a significant one, if bank depositors remained calm and did not withdraw their money. However, this has not been the case so far. The slower dynamics in many sectors of the economy, such as the case with technology startups, initially led to a reduction in deposits at Silicon Valley Bank and later sparked panic and doubts about its ability to respond. Many customers, who exceeded the $250,000 insurance limit provided by the FDIC, withdrew their money due to concerns about the bank's capacity to fulfill its obligations. And the collapse of Silicon Valley Bank has caused many people who had money in regional banks to decide to move it to larger banks in the country because they believe they will be rescued if the worst happens. Also, they may opt for alternatives such as short-term treasury bonds, which are safer and offer higher returns. This uncertainty has caused the stock prices of these banks to plummet, making it virtually impossible for them to raise capital through stock issuance. It has also raised concerns among depositors, creating a vicious cycle where stock prices fall, depositors worry and withdraw their money, further worsening the bank's situation and causing further declines in the stock. But before telling you about the program implemented by the Federal Reserve to help banks, I want to invite you to a free 30-day trial of Audible, where you can explore thousands of audiobooks. You can access it through the link I will leave in the description. In early March, the Federal Reserve announced an advance program through which troubled financial institutions can use assets such as treasury bonds as collateral for loans up to 1 year. The program initially led to an increase in the Federal Reserve's balance sheet due to this injection of liquidity into the system, contradicting the reduction it has been implementing to combat inflation, but since then, it has continued to decline. However, despite the implementation of this program, another bank fell, and on May 1st, First Republic was absorbed by JP Morgan. First Republic became the second largest bank failure in the history of the United States after Washington Mutual in 2008. Although this bank generally had better stability than Silicon Valley Bank, about 68% of the bank's deposits were uninsured, which triggered massive withdrawals that the bank had to cover by selling mortgage loans, which, like treasury bonds, have declined in value due to rising interest rates. The bank had to resort to short-term loans from the Federal Reserve, but the FDIC determined that the bank couldn't sustain itself, and it was necessary for it to close. Although some of the hardest-hit regional banks, such as PacWest, which has seen a decline of around 75% in its stock, have reported that deposit withdrawals have ceased, the fact that shareholders lost all their money in other banks that experienced a similar situation has caused the market to continue punishing the price of these stocks, and depositors' fear has increased, even if the bank where they have their deposits is financially sound. This keeps the risk very present, and the calls for calm from people like Jamie Dimon of JP Morgan, Joe Biden, the IMF, and many others are not enough to stop the fear and restore the confidence that is so essential in the system. While it is impossible to determine which bank will be next or the extent to which this crisis will escalate, it is quite clear that this uncertainty will lead to a credit contraction. In fact, the Federal Reserve expects it to serve as assistance to its monetary contraction program that it has been implementing with the goal of reducing inflation. And you, what do you think? Do you believe this situation will worsen, or has it been blown out of proportion? Share your thoughts in the comments. And if you found the information in this video helpful, you may want to watch the next video. See you next time.